Hello and welcome to this Wednesday's morning market briefing. We've got lots to talk about, but firstly, the US faces a Liz Truss-style market shock as debt soars, as well as that, Israel claims UN resolution prompted Hamas to reject a hostage deal. We've got lots to talk about in the charts, also with lots happening on the economic calendar. We'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is of course on the topic of the US debt crisis. Now, the US does face this kind of Liz Truss-style market shock, with the head of the Congress's fiscal watchdog is now warning of a large market shock. This comes as the watchdog warns that if the government ignores the nation's ballooning federal debt, a Liz Truss-style market shock could take place. Now, this is most certainly not the first time that we've spoken about the debt crisis within the US. Now, this is a debt crisis, of course, facing most of the advanced economies around the world, especially within the West. If we think traditionally to the Eurozone or Britain or the US, as we're talking about here, all of these nations, or all of these economies, are dealing with a great deal of issues in regards to their debt, and this comes after years and kind of shock after shock to the kind of economic system that they're dealing with. So for just some wider context, of course, we do have the COVID-19 pandemic, which did of course create a great deal of market shocks and forced the government in most of these advanced economies to basically intervene in some sense, whether that be in the US with their stimulus spending, in the UK with their furlough scheme, or in the Eurozone with their their federalized their different the nations within the Eurozone obviously had their respective responses as well. So we definitely saw a very expensive response by these advanced economies during such a crisis. And whilst that of course was maybe needed to deal with the issue at hand, this this kind of action by these governments followed, of course, years and years of spending more than they were kind of earning, as the governments kind of built up this larger and larger debt pile. And if I had the graph, I would show you, but just further down into this article, it does show how since the Bush era, since ending off the Bush era, pardon me, when we did see the financial crisis within the US in 2008. Since then, the US has kind of been on this upward trajectory, debt-wise, with that debt pile just climbing, and that's of course explained by, beginning with the financial crisis, the required spending that was needed to kind of bring the US out of that kind of period of depression. And that was seen also, of course, within other nations within the West and their economies, such as in Britain with the Eurozone once again. So across the kind of Western world, across all these nations, we have seen a great deal of spending to deal with these continued issues being faced by these large market shocks and economic depressions. Recessions would be the better word, but ultimately, in between both of these recessions, we saw government spending a great deal of money. More importantly, this was the case with the US, and through the Obama era and then the Trump era, a great deal of debt was added to the pile that the US is now facing, with that firstly being with Biden and Obama, so Obama and Biden, with their higher spending than what was seen with Bush pre the financial crisis, and then with Trump, we of course saw him extending those tax cuts, which did add to the US fiscal debt pile. And then of course now with Biden, dealing with the kind of aftermath of COVID-19 and his more fiscally loose policies, does mean that ultimately the pile of debt has risen to enormous levels not seen before. And of course we've covered this in previous market briefings with the fiscal watchdog that we're talking about in this article, the CBO, the Congressional Budget Office, I believe is what it's called. But basically they're saying that should the current levels of debt within the US economy continue to rise like we've seen, and that's what's to be expected with the current kind of policies being put out by both Trump and Biden. Ultimately, we're going to see, the US fiscal burden reach unprecedented levels. Levels never seen by the US economy, despite not being in a world war at the moment, which of course is a very worrying prospect. And what this could create for further generations, that is up for you to kind of think about and decide. And of course, if this does take place, if the US does still face this kind of unprecedented path of their fiscal burden growing, ultimately what the fiscal watchdog is warning is that kind of Liz Truss-style market shock, where we did see, of course, the pound drop monumentally. We saw pension funds go into frenzy, and we saw the markets kind of crash within that kind of short period following Liz Truss's mini budget. So, and what triggered that? Just going back a second, that was ultimately the kind of worries around what levels debt would reach, and also how likely the UK would be to be able to pay back that debt, with many of these kind of watchdogs and ratings agencies downgrading the UK's debt rating as a result of that kind of mini budget. So this is a real issue that is facing the US as the US debt figure does soar, of course, with the director of the CBO saying that the US fiscal burden was on an unprecedented trajectory and risking a similar crisis to that of the Truss government in 2022. The key risk lies in higher interest rates, raising the cost the US has to pay to its creditors, and if that figure reaches $1 trillion in 2026, the bond markets could snap back, with the CBO currently reporting the US's federal debt pile to be 97% of GDP in 2023, with the US's federal debt pile climbing significantly since the 2008 financial crisis and accelerating in size following a huge stimulus spending during the pandemic. The fears of the US federal debt pile climbing too high is based on the financial promises both Trump and Biden have made heading into the election season, with Trump promising to renew his tax cuts and Biden promising increased spending. The CBO also issued new longer-term economic predictions, which put the US debt levels rising to 166% of GDP by 2054, which of course would be so significant, and it's kind of hard to kind of conceptualize that. Now, the US has now been stripped of their AAA debt rating by Fitch last year, and Moody seems likely to follow this year after changing their outlook from stable to negative in regards to the US's debt issue. And if Trump renews the tax cuts, which he will likely do if he wins the election, and he is likely to win the election at the moment, polls are saying, if he does renew those tax cuts, another $5 trillion will be added to the federal debt pile. So, a very significant crisis on the hands of the US, and I think one that's kind of, not so much touched upon, within the traditional media and within, the everyday news, which maybe, citizens are reading within the US, but ultimately one that affects markets greatly. So I think it's very important to highlight it here. That's all to talk about on this article, though. Sorry for spending so much time on it. Next one to talk about is in regards to Israel. If I can scroll up there, pardon me, sorry about that. But ultimately, Israel claims UN resolution prompted Hamas to reject hostage deal. Now, Israeli officials have now claimed that the UN's security resolution calling for a ceasefire in Gaza has encouraged Hamas to reject a recent hostage deal. This comes following Monday's UN resolution, which called for an immediate ceasefire, with the US administration ignoring Israeli pressure to veto the resolution as done before. Now, we've of course been covering this topic since the October the 7th massacre, when of course Hamas did storm Israeli borders and then massacre a great deal of civilians as well as Israeli soldiers, and since then of course Israel's launched their own Gaza offensive, their own kind of military offensive into the Gaza Strip to rid Hamas of its political power and leadership within the Gaza Strip. But as a result of that, we've seen a great deal of humanitarian fallout. We've seen a great deal of costs arise out of this war, with a great deal of civilians impacted, of course, due to the fact that, of course, Gaza is a very small strip and very dense urban-wise, very dense with its population, and as a result, there's been a great deal of kind of calls by organizations and international bodies such as the UN for these kind of resolutions, for these ceasefires, and we know, of course, that the US arguably is the strongest ally to Israel, at least the strongest significant ally to Israel. And the US traditionally has supported Israel through their kind of conflicts and issues, backing them all the way. And we do know, of course, that the US does kind of fund Israel in some parts, military-wise as well. Now, ultimately, what we're seeing here, though, is this kind of switch in kind of positions by the US moving away from its position standing side by side with Israel to one which is more so kind of neutral and looking at the wider scheme of things. Now, of course, since the very start of this kind of offensive into Gaza, the US has kind of been hesitant, but ultimately has supported Israel's efforts to rid Hamas from Gaza. But ultimately, as the humanitarian costs have risen and as the civilian death toll has risen as well, ultimately the US has kind of distanced itself more and more from Israel. In particular, of course, the Biden administration, the more progressive administration in comparison to Trump's, is of course less kind of supportive of the more far right war cabinet which is currently in power within Israel. So that's kind of caused a great deal of conflict and caused a great deal of strained relations between the two powers. And what we're seeing here is, of course, the US now kind of not vetoing the UN resolution for a ceasefire in Gaza, which traditionally it would have of course vetoed, being on the UN Security Council. And by not vetoing it, Israel's now very upset with the US on making that decision, and it seems like there's going to be a great deal of fallout from that decision as well, with this decision by the Biden administration furthering the divide between Netanyahu and Biden over the conduct of the war in Gaza. Biden's worries over the potential humanitarian impact of further offensives into Gaza Strip by the IDF has pushed Biden away from the traditional US ally of Israel. The Israeli delegation, which was to visit Washington, has now been cancelled following the decision by the US to not veto the resolution, with Israeli officials immediately criticising the US's move, saying the resolution led to Hamas's rejection of a US hostage deal proposed on Monday. And following Hamas rejecting the hostage deal, Israel has accused the US of making a moral and ethical mistake by allowing the resolution to pass. Another important point to make is, I believe, Israel has removed its kind of officials and delegates from Qatar now, where of course these kind of hostage deals were being discussed. So arguably that's also another thing which could add to world tensions, as of course this article and kind of topic as a whole is always important to also note, not just to understand what's going on, but also is important to note in regards to the markets, because of course the Middle East is a great producer and exporter of oil, and with Israel and the conflict within Gaza taking place, ultimately the fear of a regional conflict is causing oil's price to rise. And whenever we see resolutions kind of come through, that's likely going to affect the oil's price as well. So lots to talk about in this article that we've covered, but we've covered lots on the article, but that's all to talk about on the articles as a whole. Next thing to talk about, is the charts. I can't get my wording right today, but to start off, we are of course on the US 30. where not too much is happening, not too much has moved from yesterday, but ultimately I think it is important to note the fact that price hasn't significantly moved away from that 50% Fibonacci retracement level, which we did note in yesterday's market briefing as an area where we were expecting price to react with, should price then continue to the upside. That said, price is now spiking into that key liquidity zone that we've noted just below that 50%. So, a key area where price may find that kind of bullish liquidity before a move to the upside. But as we've said many times, if we're not seeing the economic data following through, when we do see these kind of retracements and we're not seeing any economic data come through, it's likely that markets are going to stagnate. Not much is going to happen. So, I think that's something that's also important to reference in regards to the charts at the moment, as the picture is looking quite slow, but ultimately price is actually within a very interesting level. So I think that's very important to note, and I definitely think there's certain bullish opportunities for the US 30, for the Dow Jones going forward. Next topic to talk about though, next asset to note is the dollar, of course, the one that we always talk about, where prices seemingly moved now away from that 38.20 Fibonacci retracement level. We noted that level as an area, the first area which price could interact with before moving away. We noted that both a 50% and 61.80 both line up with a more key area of liquidity that we would expect usually for price to react with. That said, it seems like price is now moving away from that 38.20. So whilst price has not exactly tapped it, coming in within proximity does make it seem like price has now reacted to that level and is now on the move back to the upside. So definitely keep your eyes on the dollar, because we're not seeing too much kind of bullish momentum come away from that 38.20, whilst we are seeing a somewhat reaction to it. So I think that's important to note nonetheless. Whether price can now break above this liquidity zone and strong resistance level is truly the question we should be asking. Next asset to note though is Euro USD, which of course has been making some very interesting moves recently, and starting off the week we did note how this area of liquidity was going to be very interesting in regards to how price may react to it, and just as we did expect, price has reacted in a very bullish manner, moving away from it to the upside. But as we did note in yesterday's market briefing, the way price was moving was it was now retracing back up to some of these key Fibonacci retracement levels, and that key liquidity zone lining up with that 38.20 did create this kind of picture within our heads that possibly price would make its way up there and then sell off from that zone, and that is seemingly what has happened. That said, we haven't seen too significant a move away, but that single bearish engulfing candle has taken out the progress of multiple hours of bullish movements which did take place for price to reach that 38.20. So I certainly think it's important to note this area as a key area of bearish liquidity, and definitely note that there's a chance now, most certainly, for price to continue to the downside, of course depending on the economic data. We are getting some economic data today from the Eurozone, such as Spanish inflation rate, Eurozone consumer confidence, economic and industrial sentiment figures. Both of those I think will definitely serve to move markets, but obviously look out for any key data in regards to the euro when we're looking for movement to take place. Next talk about though is pound yen, pardon me, forgot my words there, but ultimately price has now moved away from this 50% Fibonacci retracement level, which we did note as the area which price was sitting around to start off this week, and so we were kind of expecting a move away from that area, and seemingly that has now taken place. That said, price is now consolidating, it's not really moving and continuing to the upside, so possibly price now may wait around this area of liquidity, just above this area of liquidity, So, definitely keep your eyes on pound yen. Next talk about though is Bitcoin, which is currently retracing. It seems like price is now making its way back down to this key liquidity zone. But I do think it's important to note how there's certainly a chance which Bitcoin there's certainly a chance that Bitcoin is now reversing. And if I was to explain my kind of understanding of that, I would basically just say that price has now made its way up to and tapped in a very significant manner that 7860 Fibonacci retracement level, and whilst some would say, well, price is broken above this key area of liquidity. Whilst that may be true, of course Bitcoin is by far the most manipulated asset within the markets, in my opinion, especially out the ones that we've kind of noted. And so when if anyone's looking to start shorting the market in Bitcoin and they're looking at this chart, ultimately, where are they going to find the liquidity? They're going to find it around these levels, where a great deal of stop orders are going to be placed on shorts. And so I think that's certainly a kind of topic or a kind of idea which is important to note in this current market landscape. So definitely think about that and definitely understand that there is now an opportunity for price to run to the downside. That said, price could now just be hooking back and interacting with this key liquidity level before continuing to the upside. So lots of opportunities shaping up on Bitcoin and a very exciting time for crypto nonetheless. That's all to talk about on Bitcoin though. Gold is next to note. Not much is happening on gold. Price is kind of ranging, quite volatile at the moment, but not too much to say. Lastly to talk about in the charts though is oil, of course, which is currently experiencing a great sell-off to the downside and is pushing into this liquidity level. The question is whether price can reach underneath this liquidity zone and tap this level once again before continuing to the downside. This is obviously we're seeing this kind of sell-off now take place largely because of basically this UN resolution, it seems, with this likely creating a ceasefire, which will then of course reduce tensions within the Middle East and therefore alleviate some of the worries over the supply of oil. So that's a very important comment to make on the topic of oil, but that's all to talk about in the charts. Lastly to talk about, of course, is the economic calendar. Not too much is coming up today, and the data isn't too significant, but we should get through it nonetheless. Firstly, we're getting the Chinese industrial profits figure, followed by the French consumer confidence figure, and then the Spanish inflation rate figure and business confidence figure. Followed by that, we're getting the Eurozone consumer confidence figure, as well as the Eurozone economic and industrial sentiment figure. Followed by that, across the pond with the US, we are getting the US mortgage applications figure, and then a Fed official speech, that being Fed Waller. And then finally, to end off the day, we are having the Bank of Japan's summary of opinions being released. That's all to talk about in the economic calendar, though. We've covered lots on the articles, lots on the charts, and lots on the economic calendar. Hope you have a great trading day, but that's all from us at Wildwood Capital. Have a great one. See you later. Bye.